Right now, you don't need a ticket to be live on Facebook for the Tuesday edition of the Not Your Average Investor Show, the JWB Rental Liquor Property of the Week. I'm your host with a slightly tempered voice today, Pablo Gonzalez. With me, as always, the man that I like to call GC, because he's got genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, GC.
Hello, everybody. Great to be with you.
And we don't have our magnificent community manager, the one that brings us the moments that matter. Madison the Magnificent, she is out today, but GC is going to be doing his best at giving us good news shortly in a second. And I want to welcome our community to the house. We are already checking in here in the chat. I love seeing everybody's names. And, if you're listening on the podcast, I love it. Thank you. And if you're watching on YouTube, I love you. Thank you. If you want to get the best out of this experience, go to nyais.com, register in the little thing, let the calendar invites flow like wine, and join us for one of these parties out here so that you can be part of, what is it, Jason?
The roll call.
The roll call. Bear with me here. We got Denny Davis checking in. Guten Tag, Denny Davis. We got John Henning, our leadoff hitter, checking in. Good afternoon. We got Lee Bishop, the MVP of the Not Your Average Investor Show community, saying good afternoon, everybody. We got the fairy godmother of the Not Your Average Investor Show community, Jen, fills in saying, what's up, party people? Jen can party. This just in. For the record. All right, Chris Gonzaga from the illustrious Hudson Valley, New York. He's saying, hello, everybody. Sad day, had to close the pool. Chris, coming down to Florida. Pool's open all year long. We got Nadeem Shah checking in out here from the West Coast. Good morning, good afternoon, JWB family. Hope everyone is doing well. We got the man that everybody knows, Noah Randari, saying hello, everybody. Another great day. We got Lewis Hudnell from my favorite place to mispronounce. Good morning from Milipitas, California. Good to have you, Lewis Hudnell. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
He's saying good morning from the Bay Area. Leo and I are trying to figure out a way to meet up today because I'm here in a conference in Redwood City. I'm having some scheduling concerns, Leo, but I'm trying my hardest. I promise, man. I want to see you. Who else we got out here? Ken Moline, the patriarch, with Carolyn Moline, the matriarch of the first family of the Not Your Average Investor Show community there in the house. And we salute you. That's good, man. That's the best one we've done so far.
Especially being remote.
Ken, I'm trying to meet up with you too, man. I'm having a really hard time out here with this conference. We got Raj Bantu in the house saying hello, everybody. We got the ringmaster, Drew Barnhill of the Not Your Average Investor Show community. Drew Barnhill saying good afternoon to all. And Carolyn, I'm assuming that's Carolyn Moline that's saying she's in the house as well. We salute you. And we're good. GC, I know that Madison is in here. Oh, by the way, Denny Davis is putting here in the Q&A. I saw Beyond Van Gogh in Sarasota. If you're in Jax, it's worth the money. Great job, JWB. I'm super pumped up about it, man.
Very cool.
Yeah, very cool. So Madison the Magnificent isn't here, GC. Do you have something to share with us that could be good news?
I'm going to do my best Madison the Magnificent impression here. Forgive me, because there is no equal to Madison the Magnificent here. But I do have some good news that we wanted to share with you. And this comes from our Tuesday meeting. So every week we meet in our Tuesday meeting. So all 100 people or so at JWB, we meet every single week. We think it's that important. But every month, what we do is we actually break down the entire business and we show how much we produced in each of our departments. And we compare that to what our business plan. And this creates transparency. It creates knowledge and understanding of the entire business model, how one department affects another. And it's an incredible accountability measurement, because you never want to be that department that stands up and like not hitting your numbers. So we love this. And so we just did this on Tuesday, and a couple of things, just really cool successes to share, but also kind of like the inner workings of how all the magic is made as far as producing great returns on investment for clients. So the thing that Madison picked out and wanted me to share is she noticed here that a couple of things just really worked well. So one thing, big shout out. So our leasing team moved in 148 new residents just in the month of August. That is a new JWB world record. So we're super excited. Big shout out to the leasing team. And then we also set a really high number for the number of renewals that we had. We had 116 residents decided to renew with JWB. And again, renewing at market rent, right? We don't limit the rents, right? It's at market rent. So 116 renewals. So when you have those two things happening, beautiful things happen for your returns. And the thing that Madison pointed out, and I wanted to share on her behalf, is we also looked at the number of turns that we have. So every year we're like, okay, we have this many properties, we should have this many turns. And we, of course, track that. If there's a goal out there that we want to miss and come way below, it's turns, because turns equal, more cost for owners. And that's why we sign long-term leases and renew. Well, what do you know? Our turns number has been below what we expected it to be 3 straight months. And so that's how this thing works, right? You sign long-term leases. You do a great job of renting out homes with long-term leases. Those residents have a great experience, and they decide to continue to renew for multiple years, and you have lower turns than you expect. And that's, ultimately how we drive those returns on the property management side. So incredible good news. Great shout out for both leasing, renewals, and of course our turn team, which does a great job. But we would love to give them more bandwidth by not having so many turns.
That's really impressive, GC. I like, number one, I don't think that it should go underestimated, this idea that as a company, you share your numbers monthly. Like, I would love to know how many people's companies in the chat do that, right? Like I my business crush on JWB is ever effervescent. So this idea that you operate in this transparency, the team knows everything that's going on, and then the numbers that you're reporting, right? This idea, like we just had a show of ROI busting myths, right? And this idea of keeping people in their homes being the key driver, and that being exactly what you need to dive into. Great number of leases, great numbers of renewals. I was one of those, right? Like Katina, my latest property, that, as you know, I was a little bit worried because I went through the eviction on Minosa, and that's been expensive. And I knew that Katina was coming up for a turn, and I knew that it was going to be corrected to like an extra $400+ a month in rent. That got achieved, man. So I'm super pumped about that. Yeah, we got that news recently, which was phenomenal.
That's incredible, man. It's the first time I'm hearing about that, man.
Yeah, that's right. That's right. I know you didn't know about that. I want to welcome Pedro Naciaceno from Jers, who's back in the house. We had somebody else check in. We got Donna Chica checking in. Donna Chica, good to have you here with us as well. GC, so that was some good news, but I also heard we got some I can't really do it with my voice right now because it's a little bit hoarse. Breaking news, GC. What's breaking?
All right. So I did my good news Madison impression. Should I go into my Grim Reaper, I think terrible news mode now?
You did a nice job with the good news, Greg, but we know that you're a dark cloud of news that descends upon this news feed. Go ahead, buddy.
Well, so here I'm going to bring the realness when it comes to what's going on in the overall investing world right now. I've of course been reading the articles. Many of you are aware of the pummeling that the stock market has taken recently. So I wanted to share some of those headlines. One stuck out to me and I just thought it was incredibly accurate. Stocks are annihilated on September 13th, 2022 by soaring inflation and rates. And the follow-up, well, so much for that. It took one day to erase nearly a week's worth of gains. An almost 6% rally in the S&P 500 was gone in less than 7 hours. And here's the thing. I just went to an amusement park with my kids. I went to Universal Studios last week. It was this amazing experience. Get to spend time with my kids and my wife, and we get to go and do that. The worst part of that experience, though?
What was it, GC?
It was realizing that I'm 40 years old and that I can't go on roller coasters anymore.
What does that have to do with this, Greg?
I'm going to show you, right? So I realized that when I was younger, I loved roller coasters and I hadn't been on them in years and years and years. And my daughter, who I just love hanging out with, 10 years old, she's like, "Daddy, will you go on the roller coaster with me?" And I did, and I hated it because I had motion sickness. I wasn't myself for 2-3 hours afterwards. I had to tell my daughter, I can't ride the roller coaster anymore. So as I'm reading this headline and I'm seeing everything that's going on in the stock market lately, I'm asking all of you, if you're in the stock market right now, if you have a lot of your money in the stock market, why are you riding the roller coaster, right? I can't ride the roller coaster anymore. I realize that. I can't ride the stock market roller coaster. I choose I don't want to do that. And I really can't ride real roller coasters. And I think, for those who are continuing to invest in the stock market, keep their money there, they might have the mentality that, listen, the market is down this year. I'm just going to ride it out until it gets better. prepare yourself that you might be a 30-year-old or a 40-year-old or a 50-year-old or 60-year-old, but that same experience that I just had where I realized I can't even go on a roller coaster with my daughter and not be motion sick for the next 3 hours, 4 hours, that's what you're setting yourself up for. Because here's what's going on. The reason there was such a roller coaster, the reason that the S&P took such a dive is because of the Consumer Price Index report, which measures inflation. Came out at 8.3% this month, which was higher than people wanted to believe it would be, because people wanted to believe that inflation was coming down at a faster rate. It was higher than expected. So one report out there creates a fire. And then a lot of emotional investors jump on this fire, jump on this train of emotion, and a lot of things change in a very quick amount of time. That's how you erase all of these gains. So the S&P dropped 4.3% in one day. Again, let's talk about those articles that you're reading about real estate and people are saying, oh, geez, we're poised for a crash or things like that we have debunked on this show. But real estate is still appreciating year over year, right? We haven't lost any value. And there's so many headlines around it. But in the stock market, you lost 4.3% in one day. If I annualize that, that would be this insane amount of loss. But some of you are keeping your money there, right? That's the biggest one-day loss in this bear market that we've had in the S&P 500.
So far, right?
So far. And we're down 19% year to date. So let's start holding the stock market decisions, the decisions we make to put our money and keep our money in the stock market, to the same standards, right? Because right now, if you look at it objectively, things haven't been good and there is still more pain to come. And here's the new nugget that I wanted to share with everybody. Okay. And I just came to kind of understand this in the last week or so. I was listening to John Burns talk about this, and I just think he's spot on. There's more pain to come. There's more pain to come for this economy, and there's more pain to come in the stock market. And the reason is because if you look at the CPI, right, CPI needs to come down. The Fed's mandate is to get it close to 2%. We're at 8.3%. That's a long way away, right? So it needs to come down. What the Fed is doing right now is raising interest rates, okay? And that is quelling demand on home buying. That is normalizing the home purchase market. That's normalizing sales prices. And that's one way that they can, make homes more affordable, right? And that's one way that they want to, of course, bring the CPI down, because housing is a huge component of the CPI, the Consumer Price Index. It's one of the major contributors. So the Fed, by raising interest rates, they're saying, okay, well, home purchases, housing is going to normalize, right? It's not going to continue to grow at 20%. We can get CPI down that way. But here's what a lot of people don't realize is that by raising interest rates and making home buying more affordable, you're pushing a whole lot of demand over to renting, which is wonderful for all of our not your average investors. That's why rent rates are expected to continue to rise. You're pushing this demand to renting. Well, the CPI is made up of ownership, housing costs. That can either be ownership costs or renting costs. So as you're pushing demand to renting, you are still going to see increases in rent rates, right? Raising interest rates is not going to be enough just to drop CPI, because, the renting experience is going to continue to become closer to unaffordable. So it's not that simple. What has to happen here for us to actually get inflation down, a big component of this needs to be job losses, unfortunately, because job losses will actually bring costs of both renting and potentially home ownership down or normalized, right? There has to be job losses. And I'm not happy about this, but I don't see it any other way, right? It's either that or a huge supply in housing, which can happen, but it takes a lot of time. So job losses in this recession, to me, and this is my personal opinion, I could be wrong here, but I just don't see it any other way. In order to tame down inflation, we're going to need to see this. And so what this means for all of us who may have money in the stock market is job losses and inflationary times don't treat the stock market well. At a bare minimum, you're in for a volatile ride. You're in for that roller coaster if you're in the stock market. We already know that on average, during a bear market in the stock market, you lose 36% of value. We're at 19% right now, close to 20%. So that's in a normal recession. Okay. Normal bear market. So you've got, if this was just normal, you'd have some more pain to go. You know it's going to be volatile. Whereas real estate, rental properties are poised to grow in a normal rate going forward. So don't just fall into the theory of keeping your money where it is. Don't make new decisions just based on what everybody else is doing. Analyze the decision that you have invested right now based on what do you think is going to perform better over the next year, 5 years, 10 years, and be strong enough to make that decision. Don't have this sunk cost theory where you're like, listen, I lost 20% in the market this year. I'm going to wait for it to come back. Because you know what? It's going to be a long and volatile ride, and there's probably going to be some rough patches going forward. So there's the counter to Madison's good news. I think it's going to be a dark and stormy ride for stock market investors. And I've been saying this for a while, and it's panned out that way. And I still think it makes sense. So I just urge all of you to objectively hold your stock market decisions to the same decisions that you would make in other asset classes. I really feel passionate that it's going to help you make better decisions.
Wow, GC, I thought you were going to come in with a little cloud, and you came in with a tropical storm there after Madison's good news. So this is what I heard from you. One, you're getting old, and I get it. As I got old, I know that I see you as a young buck. My first old guy thing was red wine gives me heartburn, and now when I'm out to dinner and I'm at these like conference parties, everybody's drinking wine, I got to make a smarter decision and not be average, right? Because I don't want to risk this heartburn that I know is coming. So to you, like the stock market roller coaster that your inner ears can no longer handle, for me it's a heartburn situation. But I agree, right? Like we know what we are signing up for. We know that these are tumultuous times, and we can either agree to just deal with this thing or not be average, look at this thing objectively, get into this asset class. You then went into like a whole like explanation of John Burns that I think we're going to have to reserve for a Not Your Average Market Insights, because I need to dig into this thing. But what I'm hearing from you is the idea that inflation is rampant. In order to control it, job losses are going to happen. And both inflation and job losses are terrible for the stock market, and happen to be, I guess inflation makes a lot of sense for rental properties. How does job losses affect rental properties? Won't that affect like defaults and stuff like that, or higher turnover rates, things like of that sort?
Yeah, and that's good. I'm really glad you asked me that question. It's not to say that job losses are good for rental properties and bad for the stock market. But what's happening here is you're likely to have much bigger negative consequences from job losses in the stock market than you are in owning rental properties.
You're likely to have, say that again?
You're likely to have much more negative consequences from recessionary times in the stock market and job losses in the stock market. You're likely to have much more negative consequences in the stock market than you are if you own rental properties, right? Because listen, job losses are not good for any asset class. Right. But right now, unemployment is so low that in order, having some job losses is still going to make rental property investing thrive. And then the supply and demand imbalance in rental properties is so much in the favor of those who own the assets that you can withstand some job losses in rental property investing. Whereas in the stock market, you're already seeing how flimsy it is and fragile it is. One report causes the biggest loss in this bear market, like losing 4% in a day is a lot. Stock market, that happens. You just don't have that in real estate.
Yeah. Yeah, that makes sense. I'm looking at the chat. A lot of people here very relating to this idea. I guess when I think about it, every little bit of news about jobs is going to take you on a loop-de-loop on the roller coaster. And if you are a rental property owner, then it would be much more like, okay, if my resident were to lose their specific job, then maybe it's accelerating a turn. But the idea that most people don't go into like bankruptcy or default or eviction when they lose a job, because like we learned during COVID, shelter is a essential need, right? So things are going to go to food, they're going to go to shelter, and then everything else gets tempered. So even then, you're still mitigated from the idea that like this is the last case resource that's going to affect you, even if your resident loses their job. Is that kind of the way to think about it?
Yes. And the other thing just to point out is like, we are so far from unemployment being a concern as a reason to have any concern in rental property investing. Like, we're so far away from it, right? Unemployment is so low right now. You could have double the unemployment rate right now and still be at historical norms. So like, we have so far to go, like as an economy, as a rental property investing asset class, we can withstand some job losses and perform right to expectations. Where in the stock market, that's not necessarily the case. You're much more exposed to job losses, to rising interest rates for companies, because that increases borrowing costs. Like, all of these things really affect the stock market a lot more, and just flat out emotion too affects the stock market a lot more than rental properties. So we're just much better to be poised for normalization. If normalization sounds really good to you, put your money in rental properties. If roller coasters at 40 years old and more sound really good to you, keep your money in the stock market. It's just not me.
Not you. All right, GC. Well, we got a great question from Michael Santoris, but I'd like to get to the property before we hit the half hour mark. So why don't we put that on there, and then we'll dive into Michael's questions going here. But for right now, we are going to magically whisk ourselves away to 8437 McGurt's Village Lane, Jacksonville, Florida, 32210. This property has an estimated ROI of 12.13%, a purchase price, a low purchase price these days.
Ooh, look at that one.
Yeah, $200,000, but a real nice rent to price ratio with a monthly rent of $1,375. It's a 3-bedroom, 2.5 bathroom, 1,325 square feet. It is a completed construction status. Leasing status is rented, and an annual appreciation rate of 4.6%. If you are listening on the podcast, go to jwbinventory.com to look at this thing. I gotta say, it's a townhome. We haven't had one of these in a while. GC, what do you love about this property?
I thought you'd never ask, brother. I thought you'd never ask. I'll tell you what I love about this one. In addition to it being a townhome, which I will jump into in just a second, the advantages of a townhome, let's just look at that purchase price one more time, right? I think we had one property that was $200,000, I don't know, like 6 weeks ago or so, 7 weeks ago. It's just not very common to have assets, especially that are newer construction like this one is. This was built in 2018, to be anywhere close to $200,000 now, right? The median home sales price in Jacksonville is $365,000. So to be in an asset in a JWB neighborhood at $200,000, you're just not going to see that a lot. So price alone, I know a lot of folks, look at purchase price and that affects, how affordable the property is for folks. Like, this is one to take a look at when you have an asset like that. Now, how are we able to see lower purchase prices? Well, the fact that it's a townhome directly is correlated to that. Townhomes are this incredible opportunity to be in the right neighborhood so that we can produce, long-term leases, reduced turnover, all of those things that we do on the property management side, but still be able to have an asset that is on a lower price scale, right? Townhomes allow you to do that. So townhomes, compared to regular single-family detached housing, always trade or always are priced at a discount to what a regular single-family detached house would be. And it just makes sense. If all of you are able to live in a house that is detached, you'd probably pay a little bit more to do that. If you could still be in the neighborhood that you'd like to be in, and you can work with being in an attached house, you'll pay close to the detached house pricing, but you'll pay a little bit less. And that's why townhomes are so appealing. A couple other advantages to townhomes: financing is an advantage here. Some folks will call JWB and they say, "Hey, listen, I want to invest in multifamily properties. Do you have multifamily properties?" And we don't do multifamilies because it doesn't work in the neighborhoods that we want to be in, but we do a lot of townhomes. And so if you compare townhomes to multifamilies, there's a lot of similarities and there's a lot of advantages for actually having a townhome versus like a duplex or a quadruplex, right? So a lot of people don't know this, but on the financing side, it's pretty tough to be able to get the values that you need for the financing to work when you have a multifamily property, especially if there are very few multifamily properties in that vicinity. A lot of times what happens is the appraisals don't come in as high as you need them to be, which just makes you bring more money out of pocket if you invest in a multifamily property. But here for a townhome like this, there are so many comps available that it's really easy for the appraiser to be able to justify the purchase price. And so what that does is that limits the out-of-pocket for you when you invest in a townhome versus a multifamily property. And the other thing to keep in mind is a townhome has a lot of advantages when it comes to flexibility. Like, for example, this is one townhome that we are selling here on McGirt's Village. It actually is a part of a 6-unit townhome building. You can see, the next one over in the picture there. There's actually 6 units in that building. Well, for somebody who said, listen, I want to invest in multifamily, in essence, they could just technically buy all 6 townhomes under one roof and be in the same spot. It would be very similar. But you'd have a lot more flexibility if you decided to buy them as townhomes versus a 6-plex or a 4-plex or what have you. Because now that you own each of those units individually, you could refinance each of those units individually. You could sell each of those units individually. Whereas if it's a multifamily property and it's a 4-unit or a 6-unit, there's no breaking it off. You got to sell the whole thing, or you got to refinance the whole thing. So a lot of advantages to townhomes. We don't have too many of them. At times we have more, at times we have less. Right now, this is one of the only ones that we have. And so for those who are interested in townhomes, this would be a good opportunity for you. The last thing to point out is with townhomes, you want to be surrounded by a lot of successful clients so that you can make sure that you have some kind of grips over what the HOA is. There's over 30 clients that own properties right here on McGirt's Village Lane because we completed the build out of this townhome community. So all of those clients go to JWB for advice when it comes to how to manage the HOA, when it comes to voting for HOA things. So we have a high degree of control over here, which is important for you to make sure that, you don't run into a rogue HOA president who wants to start putting pools and gates and all those things, which will decrease the value here. So a lot of success and a lot of kind of control in this environment too, because of what you have here on McGirt's Village Lane.
Love it, man. Lots of love about this property. Price being right there, this townhome opportunity being another one. You talked about how a lot of JWB investors own these townhomes so that you are part of a group of people in an HOA that has the same incentives. We have one of them in the house, Sergio Prieto. Go Gators.
All right, Sergio.
He's there. He says the HOA is about $100 a month, which seems about right based on the property eval. Shout out to Lee Bishop, who shared the property eval in the chat. If you want to download it, just go into the chat and you can click if you are watching this live. And Darlene Bayer asks, is it an end unit? It looks like it's an end unit, GC, but I'm going to ask you a different question. Does it matter that it's an end unit from an investor standpoint?
It is an end unit. No, it doesn't matter.
What is that?
Maintenance costs, vacancy costs, still expected to be the same. We don't see any different performance. It's not like one sells for higher on the resale market than another. Doesn't matter.
No, but you don't get a higher rent for an end unit, anything like that?
Nope.
There you go. Dollars and cents from GC. All right, let's go to Michael Santorios' question that he had in before we popped in this property. Michael asks, Gregg, I agree with what you're saying about the stock market. Could you please speak to eviction.lab, excuse me a second, eviction.lab.org, showing August 2022 evictions in Jacksonville are 41% above the average and the highest since before 2020. Can you speak to that, GC?
First, I'm hearing of that. So I'd love to just kind of drill into the data. A lot of times the headlines and the data, leave a lot to be determined. So I would love to drill into that a little bit more. I can just tell you from our perspective, we are seeing below average evictions for our historical norms here at JWB. It's not normal, or it's not uncommon for us to be performing much better than competition when it would come to property management. That's how our property management is built. So I don't know if that's just a scenario where we're performing better than what those headlines or that data is, or maybe that data is just counting something that, we wouldn't expect it to count. Like, for example, the last time that we kind of did a deep dive on one of those national headlines, Michael, and you might have even sent this one over. It was talking about the percentage of institutional investors. And what we were able to do is really debunk the myth that these institutional investors that they're talking about are really owning 30% of the, assets in Jacksonville. That was, I think, the headline, or at least made it seem that way. And we were able to look, and actually institutional investors across the country, and Jacksonville is very similar to this, own less than 3% of the entire single family rental housing stock. So I think the best thing to do is, number one, know that our evictions have not spiked. Our evictions are they're actually below where we would expect them to be. That's what we reported in our last quarterly call. And I'd love to just do a deeper dive. And, if you wouldn't mind, send that article. You can send it. I don't know if you put it in the chat.
It's been sent. I already put it in the notes document, so we can do a Not Your Average Market Insights about it. And we'll dive into it in a couple of weeks.
Love it. Thank you, Michael.
Cool, man. Yeah. Awesome, Michael. So just to recap, tons of articles, tons of data out there. At the end of the day, when you report your data, it comes from a proprietary data flywheel of having 4,600 properties under management by JWB. And what they are reporting is the overall market. It looks like they're reporting on filings, right? Just eviction filings overall and where they are. And there is a chance that the overall market has more eviction filings than JWB, because at the end of the day, this has been a super attractive asset class to get into. There's been all sorts of amateurs getting into this thing. And, you've been doing it for 14 years. Is that also a feasible outlook here?
Sure. That's a part of it. I mean, I think so. Knowing that it's based on filings don't actually equate to evictions, right? There's many times you file, but you actually do not evict. For example, about half the times that we file on evictions, we're able to salvage the relationship with the resident, get them fully paid again, so that there's no eviction. So that was just something that jumped out to me. The other thing, if it's a percentage basis, be very, very aware that eviction filings have been so low for so long that it can kind of throw off, the percentages can sound very high, even though they might be closer to historical norms. So just some things that I'm just thinking right off the bat. And then, there can just be significant differences in how we go about property management or who is investing. There are many property management companies that the first time that they have a problem with a resident, they're just going to evict. And, for us, we still hold our residents to a very high standard, but we work as much as we possibly can to find a place where we can do right by the owner and also create a great experience for the resident. And many times after you file an eviction, there's a lot that you can do to salvage the relationship, and other property management companies don't have an incentive to do that, because if they go forward with the eviction, it doesn't cost that property management company anymore, but then they get to charge you a tenant placement fee when that resident is moved out. And we don't operate based on those incentives. We operate based on keeping your home rented, achieving high rents, and decreasing your maintenance and vacancy costs so we can get you a better return on investment. So I think that's going to be a great market insight for us to dive into. And I love that you guys keep making my job easy, me and Pablo's job easy, by giving us these questions, these numbers. I mean, I love digging into it, and I'll always shoot straight.
I totally echo that sentiment. This community makes our job easy. Today, your boy needs it more than other days, because I was out late night doing karaoke with Jen Filzen, and I'm struggling a little bit. So I love these questions. I love these suggestions. I'm actually really pumped to jump into this data thing, because it's a really cool interface that we can look into and do a average market segment, Not Your Average Market Insight coming up. Ives Richard Dole asks the question: do homes in Jacksonville have basements?
No, homes in Jacksonville do not have basements.
All right. Cool. Chris Gonzaga, question in the Q&A, also giving me support in the chat. Chris, I appreciate it, buddy. He asks, in Jax, is the zoning an issue with multifamily? Is it limited areas?
Yeah, it's the zoning is not zoned for multifamily. You could probably get, if you had a tract of land, you could probably get it rezoned for multifamily some of the time. And so I wouldn't say that that's, not overcomable, but it's not easy when it comes to the zoning. I mean, we really focus in these areas that are largely all built out when it comes to large tracts of land. These homes are in neighborhoods that were developed in the 40s and 50s and 60s. So if you see, and all of the clients that own new construction homes, I would love for you guys to chime in here on the call here. But, if you buy a new construction home with JWB, it's not like you buy one that's surrounded by, 10 other new construction homes. Largely you buy one and it's surrounded by other homes that were built in the 40s and 50s and 60s. It's this infill type of development. So the opportunities to go into one of our core neighborhoods with a kind of a blank slate, open piece of land are very few and far between. And then even if you did, it would be more time and effort and cost to rezone it to multifamily many times. Then even if you did that, it wouldn't make it as great of an experience for clients on the back end, because financing is a real challenge and purchase prices are a lot higher. So for all of those things combined, it's just never been something that's been worth it for us to really go strong with and explore, especially when you have such a great alternative like a townhome.
There you go. There you go. Great answer, buddy. All right. Gerard Wendling has a question. Hey, guys, what does the HOA cover?
Gerard, I know that we have that answer internally here. I did not check our internal docs on what this one specifically covers. Maybe Sergio knows, or maybe he doesn't know. I won't put him on the spot there. But Gerard, I just encourage you to reach out to your portfolio manager at JWB. Happy to get that information for you. Each HOA is a little bit different as to what it covers and what it doesn't cover. But get all that information to you. Just reach out to your portfolio manager.
Awesome, man. Awesome. We got a great chat going on here of Lee and Jen and folks telling me how well I did in the keynote speech. I just want to say out loud, like I would not be at a conference speaking about community and strategies for a community if it weren't for this community, right? Like when I speak at conferences, I am speaking about you all, right? And I'm speaking about this beautiful thing that we have created. So I just want to really just say thank you from the bottom of my heart that I get to do this, right? Like, so I see the chat talking about this keynote and I broadcasted it on Facebook. I just wanted to acknowledge you all because I literally would not get the chance to do this if Gregg, you hadn't seen this vision and our community didn't show up and become this like amazing thing that everybody wants to hear about. You should have heard Jen yesterday talking to folks. We were talking to all sorts of, because one half of the people would come up and talk to me about like the whole community ploy. The other half is like, wait a minute. So rental properties in Florida? Tell me more about this thing. And you should have seen Jen just going on speaking point, right? Like every concern that they had. Well, what about the residents? How do you treat the residents? I heard landlords were bad. No, you don't understand. Like JWB has this like long-term outlook and it's long-term stays and they keep people in there and they treat, and we're called residents, not tenants. And, like you should have heard Jen just kind of like knocking through all of our speaking points. And it was just this like wonderful kind of snapshot of our growth as a community that we've all learned this language. We've all learned how to dispel these myths that everybody has struggled with real estate. So sorry, I went on a tangent there, man, but I had to gush a little bit.
I'm so glad you did. So I was watching the presentation yesterday, Pablo. You absolutely crushed it, man. And as I was watching it, it was like there have been these moments, these milestones that you and me and Jen and the core folks in our community, we've just kind of got to experience over the last two and a half years now. And watching you do that keynote presentation was one of those like moments of just like real extreme, just like genuine like pride. I experienced that when we did our meetup here in Jacksonville not too long ago. There's just been maybe like 3 or 4 moments. And as I was watching you just crush it on stage, and I was watching Jen, who came out to support you right there. And she was wearing the Not Your Average Investor polo. And I'm just like, man, it's all these great things just coming together. And it's been the vision that you shared with me in the beginning. When you sat me down, we had a drink together in December of however many years ago. And you said, this is the thing. And I was like, all right, well, it's different. Let's give it a whirl.
Yeah. And I'd also be remiss without the idea of how much it fills my bucket that I'm like here. And the Molines are like, let's grab dinner. And Leo's like, hey, man, I got to come meet you for a beer. And I'm like trying to fit it all in because I've got this like really hectic schedule. But man, I love it so much, right? Like I really feel like anywhere I go now in the US, we have somebody that's part of our community that I would love to grab a beer with if my schedule allows and or just come over for some tea, no red wine, right? Because I don't invest in the stock market anymore. But anyways, man, yeah, it's been really, really wonderful. All right, let's get into some more Q&A. Lee Bishop asks, Gregg, it is common to finance the closing cost with traditional loans into the mortgage. Is that something that JWB steers investors away from when purchasing turnkey rental homes with JWB preferred lenders?
Yeah, it's a great question. So what Lee's talking about is if you can actually roll your closing costs into the purchase of the house, and it limits your out-of-pocket expense as an investor. And so it's a really cool idea, and sometimes it does work in rental property investing or in just general acquisitions of real estate. But you don't see it with JWB properties. And here's why. In order for that to happen, you have to bank on the appraisal coming in higher than the market value, right? So you basically, because what's happening is if you've got $4,000 in costs or whatever, you've got a $200,000 purchase, you'd make the purchase price $204,000, and then you would limit the out-of-pocket for the investor, because they would be financing that. Instead of putting $4,000 down for closing costs, it would be a fraction of that. But the problem is then that property has to appraise for $204,000. And so, turnkey providers sell their assets at market value. Most of them do. And so you don't see it a lot in the turnkey space, just simply because if it's sold at market value, chances are that it's going to appraise at $200,000 in this case. So what I would say is it's a great idea. If you can do it in your purchases, I think it's a wonderful idea. It limits your out of pocket. There's always value to using other people's money for doing that in a smart way. But you're just not going to see it with JWB properties, because it doesn't happen often that your property appraises more than what we would sell it for. And we just want to have a model that's going to continue to work and less variables, and don't want to, inflate your expectations of the limited out of pocket cost only to be crushed later on because of appraisal. It just doesn't work. So won't see it a lot, or you won't see it with JWB properties.
Yeah, there you go. Pedro's bringing up an interesting thing here in the chat, right? She's saying, I think Pedro is not on Facebook. So he's saying he's not in that Facebook group, but he's wondering if this idea was brought up in there. The idea being forming a small group of JWB investors, which then can pool capital for future home JWB purchases. He's thinking of shared risk and maybe gets our own personal targets faster. I would like to bring up the idea that you and I have spoken about this in the past, right? It might not be these partnerships in order to buy a home. Sometimes it's like, let's pool cash together, but there's other ways of doing it, right? You've talked to me about the idea of like, hey, if you're a W-2 employee and you have the credit for it, there's people out there with money that aren't W-2 and would have a harder time getting a loan, and you can just get a partnership there. And there's plenty of value for the W-2 person as much as the person with capital. You want to kind of just like talk through that stuff, GC?
100%. Both of those could be great ideas. What I would say for either of those, and I'll get into the differences in just a second, but for either of those, what it comes down to me is the strength of your relationship with the people that you are thinking about doing business with. Because if you form a group and a partnership, then those 2, 3, 4, 5, 6 people that you come together with, that is the decision-making body when you own a rental property, right? So it isn't an illiquid asset. And so just make sure that you do that necessary due diligence that you would before going into partnership with somebody. From JWB's perspective, man, I think that's an awesome idea. And if we can rally it around the Not Your Average Investor community, I know that we think more alike here. And I think that would be incredible, and we'd love to help you do that. But I just want to caution everybody, right? Like, the hardest thing when it comes to a partnership is just choosing the right people. So evaluate this just like any other business partnership, because I would hate for you to get in, be able to pool the money, create an entity that would be buying the properties, only to not have the same decision-making criteria with that person 6 months or a month or a year later. This is built to be a long-term hold, 10, 20 years. So keep that in mind. With all that warning being said, I think it's a fantastic idea. We have had clients do that. Largely, it is some type of strong family or friend relationship for many, many years. They kind of do that due diligence. And they can purchase homes. They can pool money together, all those good things. So it's easy if you're just doing it with pooling money. I mean, you just gotta, we create the entity and we're off and running. Your point, Pablo, is really cool. I mean, that's how I got started. Many people don't realize that you can bring a whole lot of things to the table in a partnership that aren't named money. And so if you're looking at this asset class and you're saying, I would love to start investing, maybe you're in your 20s and you're like, I'd love to start investing in rental properties, but I don't have $75,000 of capital to bring down. I mean, that was me in my 20s. And all I said was, well, what do I have? I had, a work ethic. I was going to work until I figured this thing out. I had a lot more time, right? I didn't have a whole lot of liabilities at that point. I didn't have, other things in my life, like my wife and kids and all those things, right? So I was running pretty lean and I had great credit. And there's a lot of 20-year-olds that are like that. And so if you are somebody like that, then you could approach somebody else who maybe has a whole lot of other things that you don't have, like, a lot of capital, but they don't have a lot of time, and they have a family and a wife or a husband and, kids, and they have a lot of liabilities, and they're time poor. And they may say, well, listen, you run this thing, right? You provide the credit, I'll provide the down payment, and we can go and be partners on owning a portfolio of rental properties, and you can share the profits that way over time. There's nothing wrong with doing that. That's how I got started in the beginning, and many people can do that too.
There you go, man. So great thing. I like the idea. So number one, I think you've always been very wise to advise this idea that when seeking a partnership, you really, really got to do some big due diligence. And that's really cool. I think it's too easy to rush into something thinking that everything's going to go great. You really got to think through stuff. Like, you really got to think through the idea of let's name the worst breakout possible and plan for conditions in that scenario and how that would work and like foresee all that stuff. So just in case if it happens, there's an easy way out, or if not, there's going to be a lot more pain. But I think that most of the time partnerships have to do with like poor partnerships have to do with like a failure of not having the same vision and core values and the things that you want to do. And I completely agree that as the Not Your Average Investor Show community, we've basically defined about 80% of that stuff, right? Like I feel like those of us that watch the show and subscribe to this line of thinking agree that it's a long-term asset, agree that this thing is going to sit there and spit cash and there's going to be ups and downs, but overall it's better than the rest of the market. And it's not about cash flow today. It's about cash flow when you need it. And then the rest of 20% is just that agreement, right? Like what is it going to look like? But I love those points, man. I love the idea of a community being something that facilitates partnerships. I hadn't really thought about that, but it makes perfect sense.
Yeah, me either. If there's a partnership to be had, I would love for it to come from this group, this community.
Yeah. Awesome, man. GC, this was a great show. Great questions. Great property. Is that property still available at that 200K, man? Are people not? Is that there?
It is. We're on a hot streak, brother, with properties of the week too. I think I don't know exactly. I think it's like 3 out of the last 4, 3 out of the last 5 have been purchased from us talking about it here on the show, either on the show or right after. So that's really fun. It's fun to see that start to work too.
It's cool, man. That was one of the things we were talking about yesterday. Like you should have heard Jen talking to, I forget who it was like a software founder that was like super interested in this whole thing. Cause when you tell them, you can invest in properties, they're like, yeah, I've been wanting to invest in properties, but they're expensive. And then we're like, yeah, like 250,000. Like, what? Cause they live in Jackson. They live in San Francisco,
right?
Yeah. So we're like diving into this thing and, Darlene, very cool.
And
Darlene's putting this show has facilitated our purchase.
Darlene picked up the property of the week last week. So congratulations, Darlene.
That's right, Darlene. Yeah, that's very cool. I think that there should be a special award for people that buy the property of the week. I've bought 2.
There you are. Yes.
So I'm not just saying I need awards, but I like it. Because where I was going is Jen's like telling people, we're like, talking about all these things. We're like, you don't understand. Like we put these properties up and we have this like tight knit community it hasn't even been this much about like new clients coming into the fold to buy properties. What we've created is just this like group of people that we're all so accountable to each other. That's created a kind of a competitive environment of who can buy the most properties, which then makes these properties of the week like sell like QVC style on a webinar, and people are buying homes. And we're like telling this story. People are like, what? It's just blowing people's minds. And I think it's amazing, man. It's very cool.
It's just fun. It's organic. We're not up here hawking properties. People are buying them for the right reasons. And then they're supported by this incredible community around them. I mean, look at the love that Darlene's getting already. It's like, that's what makes this fun.
Yeah. Darlene and Hubs is what Darlene is saying. That's right, Darlene. Darlene, you and your husband deserve all the credit. And she says she loves the QVC of properties out here. We do too. We do too. Next week on the QVC of properties, we got a special show on Tuesday, man. What do we got coming up on Tuesday? I know you're excited about this one, buddy.
We have been blessed to have some just incredible guests on the show. And the one we have coming up on Tuesday, I know that you guys are going to be super excited. We have the pleasure to host Mark Lamping, who's the president of the Jacksonville Jaguars, on our show. He is going to talk about the commitment to downtown Jacksonville. He's going to talk about the Jaguars and Shad Khan's commitment. Shad Khan is the owner of the Jacksonville Jaguars. But Mark Lamping is a big name, and he is incredibly influential and just incredibly gracious to spend his time with our community. So if you've ever wanted to talk to the president of a National Football League team, your opportunity is here next Tuesday on the Not Your Average Investor Show.
I mean, we had the CEO of a Fortune 500 company, and we're like, there's only 500 of those. There's only 32 presidents of NFL teams, and the NFL teams are like, I wonder what an NFL team market cap wise compares to a Fortune 500 company, but I would assume it's in the Fortune 1000.
Listen, there's a lot of Fortune 500 companies that you really don't talk about on a daily basis, but people talk about the Jacksonville Jaguars a lot.
Yeah. I think it's going to be really interesting. I really want to thank our community. We had 35 plus people in here all day long on a Thursday, middle of the workday. So if you're listening on the podcast, we appreciate, talking to you while you're driving on your commute or walking your dog. If you're watching on YouTube, we think it's awesome. But this idea that, our community takes an hour out of their day, middle of the workday, to come hang out and add all the value, make it easy on your boy who's struggling after a night of karaoke, is something that I really, really appreciate. And GC, I'll give you last words, bud.
Yeah, well, you know what, Pops, did a great job, man. We're all here to pick you up. The entire community's picking you up. I know that you brought your A game for karaoke last night. We can tell that you did that, and you did that today too. And yeah, thank you guys for making this so much fun. This is a pleasure. And man, I'm just so excited, not just where the show has been, but as Pablo and I are starting to think about where the show is going, and we just have all these positive moments here, again, getting the opportunity to speak with some of these guests that we're going to be able to bring to you guys in the coming months and quarters here. Like, this show there's just something so good about what we're doing. And I'm just so thankful that you all have made it what it is. It's a joy that I never knew we were going to have here at JWB. I never knew that this was going to be a thing. And I'm just really, really blessed and appreciative of what you all have made it. So thank you all. Can't wait for next week.
Right back at you, buddy. And remember, if you want to get off the investing roller coaster, if you want to avoid the heartburn of the stock market, you just can't invest like an average investor. See you Tuesday.